Hannah Kesler.
This gal started her own bank at the age of 18, and then you became a self-made millionaire by the age of 24?
I did.
Hannah Kesler is a money mentor.
She's known as the single millionaire chick.
With advice on how to stop living paycheck to paycheck.
Money. It starts with your mindset.
How you think about your money is going to greatly impact how much money that you have.
I grew up in a town called Olathe, Kansas. I'd be walking out of the door, going to school, and my mama would holler at me, "Hannah, make good choices." And I'd have to holler back, "Because the choices I make today will affect my future."
My parents, they did a very good job about teaching me as a child how to handle my money. We have a lack of understanding when it comes to money.
If you want your kids to have money, you need to start talking to them about it while they're young.
I'm really second generation to this concept that's called the infinite banking concept.
And at 18 years old, my dad gave me the choice to start my own bank that then led me to becoming a millionaire by the time I was 24.
Now you've written a book to help tie it all together.
So the companion is really just teaching kids that, not specifically money, but really important life lessons.
Now being the owner of the Money Multiplier, I help serve over 17,000 clients in every state of the country.
Where can people get the book?
HannahKesler.com. Hannah spelled the same way forwards and backwards, Kesler with one S.
Also, I got my podcast show, the Money Multiplier Podcast.
And make good choices today, because the choices you make today will affect your future. Well, good morning, my friends. How we doing? Happy Thursday, y'all. We are here in Tuscaloosa, Alabama. We have been on a college tour trip. It's my grandma and my niece. We are looking at colleges right now. So Tori is a junior in high school. Next year, she's going to go into her senior year. And she wants to become a nurse, and now she's kind of transitioning. Tori, what? You want to get into biology now, right? Yeah. So we've been up here. She wants to go to a southern school somewhere, maybe in Florida or in Alabama. So we toured Auburn this week. And then yesterday we did the University of Alabama. And then now we're going to head back home. So I am working out of a hotel today. So hopefully Wi-Fi is doing great. I'm coming through clearly. And then next week I'll be back in my studio. Let me see who is chiming in this morning. Devon, you're always here. Good morning, my friend. And then also Dexter. Hey, my man. How we doing? All right. Well, I am excited for today's topic. Now, last week, I know I ended our conversation going into term life versus whole life and the differences. And I said, hey, next week, I really want to get into the white papers, is what we call it over here at the Money Multiplier, of comparing the differences between buy term and invest the difference versus the infinite banking concept. So just going to layer deeper into different philosophies about your investing, the foundation of your financial life. However, I want to be in my studio for that, okay? Just because if I did have some bad internet connection, I really want y'all to grasp that. So that's going to be our topic next week. So chime in next week, Thursday, 9 a.m. Eastern time, here every Thursday, doing Money Mornings with Hannah. And if you want more about the infinite banking concept, just a reminder, podcast show. So the Money Multiplier podcast, it's on YouTube, or you can get it and stream it from any of your podcasting platforms. So that gets released every Tuesday on the Money Multiplier podcast. But I was kind of thinking, okay, so if you are deep into the real estate investing world, this has been a huge topic that has been coming up within the community. The Brandon Turner deal. Okay, so Brandon Turner was actually a co-host. He used to be on the Bigger Pockets podcast. A lot of y'all are probably familiar with Bigger Pockets. I don't think he's co-hosting anymore. I think he's a former co-host and he's not hosting anymore with them. But he is a savvy real estate investor, and he actually came out on Instagram saying, hey, I have this fund and a lot of folks really lost dollars because of the deal. And I really want to get deeper into what we can do as real estate investors to protect ourselves, because at the end of the day, it is investing, right? I mean, there is risk when it comes to investments. You could make money, you could lose money. All right. That's just what investing is all about. And so you need to understand the risk of when you're walking into deals so that you can protect yourself, you can protect your cash and your family, right? So real quick, I need to bring up my notes, but very few people are thinking about what happens when the market stops cooperating. And today we're really going to be talking about this deal that's making the headlines throughout the real estate community and why it contains lessons every investor should be paying attention to. I want to break down what actually happened in plain English, if you will. All right. I like things stupid simple. It's my KISS principle. Keep it stupid simple. And even when I teach the infinite banking concept, if you feel like you can't walk away and I explain this thing at a 5th grade level, I didn't do my job properly. All right. It doesn't have to be that complicated. Yeah, there's some learning. Okay. There's some terminology that we have to understand and definitions as well. But I think it's human nature. We just love to overcomplicate crap. And it really doesn't have to be that complicated. Okay. But here's what happened. In late 2021, Brandon Turner's fund called Open Door Capital partnered with Disrupt Equity to purchase a 387 unit apartment complex called Heights on Katy, and it's near Houston, Texas. The purchase price with the closing costs came around to $72 million. They took a loan of approximately $52 million. And then what they did is they raised around $25 million from investors. And there's kind of 2 tiers here. Okay. So you have we'll call it Class A. Okay. So like in the articles when I was doing my research, they call it the Class A and then Class B. And in my terminology, how I kind of think about that, Class A, I always, when I'm putting my dollars into an investing deals, I always go for the Class A. And I learned this actually from my father. And we use this quote a lot from the movie Talladega Nights, where he goes, if you're not first, you're last. And that's what it is. The Class A was really the first lien position holders on these properties, where Class B was the second position. And you'll notice, even if you are an investor, over here at the Money Multiplier, we have the community, what's called the Private Money Club. And if you're not familiar with Private Money Club, let me know. Send me an email, hannah@themoneymultiplier.com. I will send you that link where you can find more information. What Chris Noggle always calls it, it's called the dating side of money, where it's like a match.com between borrowers and lenders, right? And you'll notice when you go to the Private Money Club, those second lien positions, they're normally offering higher interest rates for that because there's more risk there, right? Because if the deal goes sour, well, who's going to get paid out first? It's going to be the people who are first in line, the first position holder. And that's what I do, right? And thinking about now my ADD going off, I'm going to be sharing a little bit even about my investments, because even in my investment portfolio, there's some things that's happening, and it's because of where we're at within our economy right now, what the rates are doing. Okay. So we'll kind of get into that here today later. But on paper, this deal, so Brandon Turner's fund, on paper, it was a solid deal. What the plan was is that they were going to purchase the property. Okay. They were going to purchase the apartment complex. They were going to renovate the units. They were going to raise rents over time. They were going to improve operations and then sell or refinance it in 4 to 5 years. And operationally, it made sense. They actually executed the plan. But here's what happened. Over the 4 years, they owned the property. The annual rents grew from 5.9 million coming in to about 7.8 million. And that's a 33% increase. And even the net operating income improved from 2.3 million to 3.6 million. And the occupancy stayed well above 90% the entire time. And when they even sold the apartment complex, it sold at a 95% plus occupancy. Occupancy. We'll just leave it at that. And the property really did look good. You know, it had new paint. They turned units. It had strong reviews. By every operational measure, the deal was working. However, here's where it fell apart. The deal was not killed by bad operations, but it was the bad financing times. When the financing clock ran out, the loan was a commercial adjustable rate loan with a 4-year term. Most of us are familiar with the 30-year fixed rates, like most residential investors, like what we're used to. But this one was a 4-year adjustable rate commercial loan. And as a result, from day one, there was a ticking clock on this deal. And when Jerome Powell, when he was still in his chair, began raising the interest rates aggressively starting in 2022, the clock quickly sped up. What happened then is that payments went up quickly. The insurance, even on the property, spiked due to the Gulf Coast hurricanes that came through, and property taxes then followed, going higher and higher. And so, as we know, like Business 101, hey, when my expenses start to increase, yet my income is maybe remaining level or not increasing as much as what my expenses are, my margins start to become smaller and smaller, right? So the cap rate shifted, meaning that the property values dropped significantly, and consequently refinancing, which had been the exit plan all along, became nearly impossible without bringing a massive amount of new cash to the table. And if you go in and look at Brandon Turner's Instagram, where he made the big post that really went viral, he actually said in there that he went back to the investors and then started to ask for new and more money. And that's not a great feeling, right? If you're on the other side, you're the investor in the deal, you're like, wait, what's going on? Why do y'all need more money now? So like I said, he tried, and they tried hard. And from here, Brandon says that they attempted multiple refinancing options and even did a capital call going back to the investors to ask for more money. In a show of personal commitment, Brandon even mentioned that he refinanced his own house and put every dollar he had into the deal. He even relocated to Texas for 6 months to be closer to the problem. And despite all of that effort, they managed to raise about $4 million in new capital. But unfortunately, the rates changed again before they could close a refinance as the market continued to deteriorate, and the deal they had nearly locked in fell through. At that point, they needed about 14 million to refinance it, and they were still 10 million short. So with no path forward, selling really became the only option. And that's where we're seeing a lot of these folks who are now, they lost their capital in it. So the best offer that they received was around 62 million to buy the apartment complex. So what happened then is that the 10 million more than the loan balance, that 15 million less than what they needed to pay back all investors. After the closing costs, they had enough to fully repay the conservative Class A investors, all right, Class A investors. But the Class B investors, my folks who were taking on a little bit more risk, having those higher interest rates, those who had taken on that risk suffered a total equity wipeout, 100% of it gone. And nearly, I mean, seeing and doing the research here, there was about 150 investors averaging roughly $100,000 each, lost all of their principal entirely. So that's the full scope of kind of what happened. You know, there's always the risk when you come into investing, and especially when you're getting into bank financing, raising capital from investors. I really want to bring to the forefront, you know, what can we learn from this? And I even wanted to do this. That's why I titled this whole episode, Stop Over Leveraging Yourself, because this was something that I really wanted to dive deeper into after having conversations over here at the Money Multiplier with our implementation team. You know, there are some people who are coming back and to us and they're saying, y'all, I made some bad choices, essentially. I totally over leveraged myself when it comes to the cash value within my policy. And now, because cash flow ain't coming in, I use that money to go and do some investing with it. Now, I don't know how I'm going to pay my premium. I don't know how I'm going to pay back my policy loans. And here's my big PSA and really actionable step. I think I even mentioned this last week when I had that conversation with my brother that I was talking about, but you need to have some reserves on hand, my friends. Okay, don't totally over leverage yourself and think that, oh, everything's going to be so hunky dory. I'm not going to have to worry about this because, hey, on paper, everything seems to be fine and working out. You need to have some dollars cash on hand reserves when the unseen time happens. Okay, literally, let's just talk about the big one happened in 2020, the COVID time. You know, a lot of people lost their job, weren't working. Maybe they had months and months and months where they weren't cashing in a paycheck. And it's just important to have that money, some cash accumulation on hand so that when times do happen, you have this cash bucket that you can keep sustaining your same lifestyle that you are now, or really start looking at, okay, maybe I need to start pulling back on some stuff because, hey, an unseen time has come and I need to prepare myself so that I don't totally go in the hole. You see what I'm saying? So what I personally do within my policies, I have 6 months of my expenses saved. Okay, this is money that I do not touch. What I do is I keep 3 months of my expenses inside of my checking account down at the local bank, because no, there's no way to totally eliminate bankers from our lives. All right. I mean, if y'all find a way to eliminate the commercial banks, please holler at your girl. We're trying to find a way to totally decentralize, but there's no way right now that we know of to totally eliminate the commercial banks. I was about to say, unless you keep some cash on hand, I guess you could do that. But even then, you know, it's not 100% the smartest thing, because then you're kind of losing money due to the hidden tax I like to call inflation. But anywho's, I keep my 3 months of my expenses inside of my checking account at the bank. And then I keep the other 3 months stored inside of my policies. And that's money I don't touch, okay? Because that's the height of the lifestyle that I'm living right now. And if shit hits the fan, I have 6 months of my expenses covered of the lifestyle I'm living now to readjust and kind of get me and float me through this next time. So that would be my biggest thing, you know, keep 6 months, keep 12 months. You can even keep 24 months, whatever feels good and right for you. Keep that money on hand. Don't totally over leverage yourself. Okay. Now, before I get into what can the average investor learn from this, let me kind of get over here and let me see some of these comments that are coming in. Okay, good. No questions right now. Please ask me questions, though, if y'all do got them. All right, so here's what we can learn. As mentioned, the real issue wasn't the bad luck with the rates. Experienced operators knew in 2021 that rates at historical lows were likely to rise. So putting a short-term adjustable loan on a deal that would need refinancing in 4 years was maybe a questionable call from the start. And the bigger lesson is about the due diligence, y'all. You need to have that due diligence, understand the deal structure you're getting into, and not just following the operator's count, or even like on social media, like their social media presence. Okay, there's even some people who are out there, some big wigs within the real estate community, that y'all, equity is not going to get you out of every single deal. Okay, so here are kind of 5 lessons that I want to give to y'all of what we need to take away from this as being investors. And maybe you are investing in real estate right now, but do your homework, do your education before you totally dive into the deep end, and bounce ideas off of people. You know, my biggest advice is that if you're seeing folks who are doing the things that you want to do successfully, living the lifestyle that you want to live, ask them the questions. You know what I mean? They're there to help you. They are there to guide you and explain certain mistakes that they have made in their investing journey, so that you can learn from it and not maybe find yourself in that same position. But again, this is investing, and there's always some risk. We're going to have the upswings, we're going to have the downswings. So here's lesson number 1. A deal can survive operational problems, but it can't survive the financing problems. And this is really the core lesson here. So many investors we're laser focused on finding the deal. We're analyzing the numbers and truly maximizing the upsides. And y'all are most of the time working on an offense. And I've even found myself guilty of that, just working off of the offense. And the offense is very, very important. However, most of us and most investors spend almost zero time thinking about what happens if the market changes before their loan comes due. Just want y'all to ask yourself right now, what does this financing look like? Okay, when you're walking into this deal, what does the financing look like? A balloon note that you're planning to figure out later? How well is that really going to operate for y'all? You know what I mean? And even into like certain strategies like the BRRRR method. Okay, so BRRRR, BRRRRR. All right, and if you don't know BRRRR, I'm not going to spend so much time on it today, but go and look that up. But a BRRRR that hasn't been refinanced because rates change, there's a little, what should I call, concern there. Even looking at a short-term hard money loan on a flip that isn't selling, you could maybe find yourself in a pickle that way. I know the hottest topic right now is the subject to deals, okay? Subject to with no equity cushion. What if the value drops? That's always a concern. And even for my folks who are in like the short-term rental space, like your VRBOs and the Airbnbs, you know, that portfolio and the dependency on the occupancy rates staying high, is that always forever and ever going to happen? And, you know, with all of this, these are all the versions of the same risk. You know, when the financing depends on a perfect conditions continuing forever, you are far more exposed than what you think. So really what I'm saying is that look at the downtimes. What's going to happen if something does go south? How are you protecting yourself? I can say, like in some of my deals right now, some of my borrowers, because that's the biggest of my portfolio right now, is being very heavy on the private lending side. And now getting into owning the properties, okay, buying those 2 rentals up there in Atlantic City, kind of go into that side. Those are doing great, okay? And then that's more of a strategy for my taxes, okay, tax savings, utilizing cost seg depreciation, okay? And it's really building, it's more of a long-term play, where my lending deals, that's more of my short-term outlook, the cash flow that I want coming in from those short-term deals. Because truthfully, I don't lend any longer than 36 months. I will not do a deal that's longer than 36 months, and I won't do a deal any shorter than 12 months. Because honestly, if I'm going to go and do this deal and go through all the hassle, I want at least 12 months of interest collected, right? That's just me. That's just my rules for myself. You have your own set of rules, okay? And follow your rules. Warren Buffett even has a saying about that, like follow your rules and stick to the rules, something like that, right? Don't get FOMO, fear of missing out. Don't get FOMO. When you're ready to sell, you should be selling. So even like within my portfolio, there are some borrowers where they ain't paying me interest right now. They ain't paying me interest. And now I have to go through some process to get at minimum my principal return to me, because at minimum, that's all I really want. Okay. All right. If we can't work this out, you ain't going to be paying me the interest. At least get me my return of principal. And there's some barriers that I set there. Okay. So like what I can say is from my lending portfolio, my lending side of my business, if you will, I will not lend on a deal more than 75% of what you're looking for. Okay. So like just easy math. Let's say you come to me and you're like, Hannah, I need $100,000. I want to go do this fix and flip on this property. And the exit strategy is that it's going to take me, let's say 8 months to do the full reno. And then I'm going to go and refinance the deal. Okay. I'll support you. I'll help you out here. But what I'm going to require is number one, the first position on that piece of property, because again, if you're not first, you're last, but I ain't going to lend up or more than 75% of the deal. So if you come to me and you need $100,000, I'll give you 75 of it. I'll give you 75, because really what I'm looking for is I'm looking for the investors who have some skin in the game. You know what I mean? If I am funding 100% of the deal, what that investor doesn't have as much incentive, if you will, to go in there and really have this thing work out, because you are coming in with 25% of it. You're carrying more, just the same amount with me in this deal as what I am. Okay. So that's just what I do when I protect myself in the down times, because I know a lot of us real estate investors are kind of feeling it right now. People are kind of sitting stagnant and we're sitting on a lot of cash. But that's just personally what I do to make sure that they do have some skin in the game there, and that, we're playing nicely in the sandbox, if you will, together. So lesson number one, a deal can survive operational problems, but it cannot often survive the financing problems. And that's really the core of this Brandon Turner deal. Now, lesson number two, social media reputation is not a substitute for y'all to go and do your own due diligence. I mean, let's just be honest. Something that doesn't get discussed enough in real estate, this keeps circling back. Okay. There are a lot of well-known names that's attached to deals, and people just start to let their guard down, right? They kind of like put this person at like a pedestal, and they're like taking their word like it's God's word. And it's like, no. You need to go and do your own due diligence on this. The follower count on social media, the book deals that person might have, the podcast interviews, they create this feeling of safety that isn't always earned. All right. Even for myself, when folks are coming to me saying, hey, Hannah, I want to really get into this infinite banking journey. I want to go do this. Y'all go do your own due diligence on me. Okay. I will even give you names. Like I've had people ask me before, okay, Hannah, like, yeah, I know you. Y'all seem really cool. I know, because I am super cool. Okay. Sorry. But can you give me some names of your clients that maybe I can talk to and have a conversation of their experience working with you? I'm like, yeah, and then what I do is I hit up that person. I say, hey, this person just wants to, kind of talk to you about how it's been working with the money multiplier. Do you mind if I give this person your phone number? Y'all can have like a brief conversation together, and that's always a good idea to do is don't just take that person who you're giving the money away to as the honest truth. Go and do your own due diligence. So there are quite a few people who look amazing on social media, but when you dig into their actual deals, some might not be as good as they are portraying them to be. And Brandon Turner, he really built a remarkable brand. Again, his work with the Bigger Pockets helped thousands of investors. And, it's true and it's real, but the fame and the investing skills are not the same thing. Content creation skill and risk management skill are not the same thing. They're different. And the due diligence is always yours, okay? I don't care if the operator has 500,000 followers or 500 followers. Before you put money into any deal, you need to understand who is the operator, and what is their reputation? What is the financing structure like? Is it going to be fixed or is it adjustable? What are the terms? What is the exit strategy here? And again, what happens if it doesn't work out this way? Truly looking at the worst case scenario, and can you live with that worst case scenario? Personally, honestly, my father is like the best at this, really looking at the worst case scenarios. We kind of call him like a worry wart. We have a joke in the family, and my mama always says, she goes, I don't worry because I know Brent's worrying for the whole entire household. I'm just kidding, my father. If you're listening to me, I love you. We're just playing. But again, this due diligence is always yours. So feeling like you have that almost like parasocial relationship with that person, especially if they are very big on social media, you can sometimes let your guard down and you need to go and do your own due diligence. All right. So really that's lesson number 2. Now, lesson number 3, yield sickness is real. Okay. And this is a term worth knowing, okay? Yield sickness. It describes investors who are so addicted to chasing high returns that they normalize taking on an excessive risk in pursuit of them, okay? Almost you can like think about, hey, let's say we're going to go to the casino and gamble, and you think that you're going to walk away with like $10,000 at the end of the night. You have that yield sickness. You're chasing the unrealistic high yields and high returns. So here's really something fascinating about the Brandon Turner deal is not everybody lost money, right? Not everybody lost the money. So about 25 million in investor capital was at stake, and that 10 million did get paid out to the Class A investors first, the more conservative ones who accepted the lower returns in exchange for being paid back first. And they got their principal back, okay? Where in contrast, by Class E folks within this fund, that remaining 15 million, those who took on more risk for the higher potential upside, they lost everything. And the investors chasing the higher returns were the ones who didn't come home with the money. And, this kind of happens too. Like I get this a lot, like when I'm having one-on-one conversations with my folks who are getting into infinite banking. And even just like investing too. Because by the way, I'm not a financial advisor, right? I'm just walking down the same road with y'all. I'm an investor, okay? I'm an educator on the infinite banking concept. That's what I do. That's my active business, right? Is helping folks learn and implement the infinite banking concept. And when people are coming to me asking about investing in different realms of how you can go put your little green men to work, we have those buddy conversations. Because personally, I'm not a stock options trader. If that's what you love to do, I'm going to turn you on to folks who are the experts in those realms. My expertise really comes from the wisdom that I've just gained over these last, almost 7 years, I guess 6 years and 10 months now being a real estate investor and just working with folks who I admire and who are in the positions that I want to be at in some point in my life. I'm just following their feedback, if you will. I don't want to say advice, but following their feedback of what would you do if you were seeing yourself in this position. So again, the investors chasing the higher returns were the ones who didn't come home with the money. And you got to also like just look at where are you at this point in your life, okay? Because my people who are in their 70s, you know, if they lose a few mil, they don't have as long to recuperate all of that capital so that then they can go off and ride into the sunset and live their retirement years, right? We're like somebody who's almost 27 years old. If I have a little bit of, I'll take on a little bit more risk, if you will, because I'm here in my youthful years that, you know, I can take on a little bit more risk. I want to see, you know, does this make sense for me? So again, like another big PSAs is that really analyze where you're at in your life and really think to yourself, okay, again, what is the worst case scenario that could happen here? And at minimum, can I at minimum get my return of principal? That's what I always look at when I'm walking into some of these specific deals. So again, we're kind of seeing these patterns everywhere right now. So for example, actually, you know, investors who overpaid for Airbnbs, assuming the COVID era, the tourism would never slow down. Those folks are really feeling the heat right now because of the environment of what's happening. Similarly, you know, even fix and flippers who are using bridge debt, assuming that refinancing will always be available or the house will sell fast. Same deal, same position. You can't always look at the, hey, everything's going to be rainbows and sunshine, riding away on my unicorn into the sunset. We got to be realistic here. You got to use some of that logical thinking of what does happen if something does go down. So many investors have normalized that gambling is, you know, that this investing, if you will, is called gambling almost, because they're going out there and they're chasing those higher returns. And you just need to be honest with yourself. What risk are you willing to take on? So again, what I do just within my own investing life is that I make sure if, again, shit hits the fan, I can get at least my return of my principal coming back to me. That's what I do. That's the rules for myself. Now here's lesson number 4. Most investors are taught offense, okay? As we kind of discussed above, what we call the yield sickness, right? Most investors are taught the offense, but almost nobody is taught the defense. And with this modern real estate investing culture, okay, with the YouTube University podcast, even real estate investor events that are popping up all around the country, everybody is so focused on the offense, the upsides, everything going magical and perfect. And we need to, again, look at what happens when the downside comes. Our defense, if you will, is kind of how I titled it in my notes, the defense here. And the message is consistent, right? They're always saying more doors, more units, more scale, more leverage, go faster, buy more, burr it out, house hack it, syndicate. You know what I mean? And it seems like we are always taught that more. And when you keep going at more, you need to also look at the failing deals. What happens if something does go south? So again, just look at the defense side. It's just my big PSA here, lesson number 4. Look at the defense side. And make sure that you do always just have yourself protected in that cycle if something does go south. You see what I'm saying? Last final lesson here, lesson number 5. Let me sip my coffee. Financing, okay? I'm actually very surprised that not a lot of more people, grammar, thank you, Hannah. Not a lot of more people are not looking at the financing of a specific deal, right? They're always coming into deals looking at how much interest am I going to earn? When am I going to get paid back my principal? What's the cash flow looking like coming in every month? But they never truly like even underwrite the deal themselves. Again, looking at what happens if something does go south, looking at the financing of the unit, the property, if there is some financing there. And the financing is part of the deal that you're walking into. It shouldn't just be an afterthought. Here's kind of like, what do I want to call this? A thought experiment, we will. Okay, so a thought experiment, let's call it this. Imagine that there's two identical houses. They're both built the same exact day, in the same exact neighborhood, same floor plan, same value, same rent that the investor is collecting. In every measurable way, they are exactly the same. One could be a phenomenal investment, and the other could be a total nightmare. And what makes the difference is the financing on both of the deals. One investor, they use long-term fixed rate debt with healthy margins. The other one used a balloon note with short timeline, adjustable rates, and really thin cash flow. Same property, but completely different outcomes. The deal isn't just what you bought it for or where it's located at. It's the financing of the deal. The financing determines how much time you have to survive a difficult market. So my folks who are locked into those 30-year fixed rates, we'll call it, they got some time, they got some cushion room. Their expenses ain't going to be going up. Where my folks who are on, like Brandon Turner, those 4-year adjustable rates, that's where they started to see themselves in a little bit of trouble. And as a result, time, it can really hurt y'all if we're not looking at the downplays of what could truly happen if something does go south. Most investors don't lose because a property instantly just failed. They lost because the financing forced them into a corner before time could save them. They either had to exit, they had to sell, really is what had to happen, and now they lost a whole bunch of dollars. So just look at this stuff. You know what I mean? I just look at the financing, really ask the hard questions, okay? And get into the rooms, get into those specific rooms where people are making moves that you want to also be seeing within your life, and ask those hard questions with them. Get real and get honest with it. Again, I just really want people to understand that appreciation just can't get you out of every single deal. We've been in this up market for so long, and a lot of people forgot really, or don't even know, okay, because it is like a mainstream thing, with everybody going out there on YouTube creating their own content of what the true foundation to a real estate business looks like. So this is a business at the end of the day, you know what I mean? And I personally just wouldn't jump into the deep end. I would really get your floaties on. All right, just picture yourself putting your little floaties on, and you're walking into the pool, going down the steps, and you're just kind of paddling around. You're doing a little doggy paddle right now, and test some things out before you go so deep into the deep end. So again, I'll be honest with you, there are some even investments that I have who the borrowers ain't paying right now, as I mentioned, and I know that I'm looking at these deals from the downside potential that I know I'm going to get returned my principal at minimum, right? No matter, you can also look at like the opportunity cost of my money, where, okay, yeah, this investor has my money, they ain't paying me no interest, but at least at minimum, I do have that return of principal coming back, right? And so you could say that I'm losing because of opportunity cost, but at minimum, I at least want my principal being returned. So this is kind of where, just me personally, in my investment journey, I more so prefer the one-on-one investments rather than get myself into a big fund. Okay, because when I have that one-on-one investing, it's just different. It's just you and that other person in the deal. You can have the real conversations. You can restructure. You can work through things if it goes south or gets tough. And you have that flexibility that simply doesn't exist in these larger commercial structures, right? Like the big funds. And simplicity is the feature, not the limitation here. The more complex the deal structure is, the less control you have when things go wrong. And things always have the potential to go wrong, my friends, right? So again, here's kind of what I'm doing. I'm having these serious conversations up front with these folks. I'm not being surface level. I'm having real conversations about how are y'all managing this business. I'm having the conversation of their debt. What is their other investor relationships like? And again, what happens if something goes wrong? I'm having those conversations up front before I'm even letting go of my money and the control of the money. Because we say this a lot within the money multiplier community. It's kind of funny. The only time you actually lose money is when you give that control away to somebody else. So stay on the front lines and be in control of what's happening. So that's one thing that I'm doing is I'm having those serious conversations up front. I'm doing my own research. I'm searching online. I'm using AI. I'm asking around. I'm looking for lawsuits, complaints, patterns. Y'all, I go and do background checks on every person I give money to. I'm going out there and I'm doing background checks. That's what I do. And you need to trust that person, but you also got to verify, right? A good reputation is a starting point, but it's not the end line. It's not the finish line, if you will. Okay. Do your own due diligence, do your own research, and get the collateral, get the good paperwork every time, every single time. I can't tell you, there's been people who've come up to me and they're like, Hannah, I lent money to this person and now they ain't paying me and I don't know what to do. And my first question is, well, what is the collateral that you have? Oh, Hannah, I have no collateral. Y'all, if you have learned nothing from the show, get the collateral, okay? This is why the rules for myself, if you're not first, you're last. If you want my money, here's a Nelson Nash lesson, right? He has a whole chapter in his book, Becoming Your Own Banker, to the golden rule. The one who has the gold makes the rules. If you do not like my terms, that's okay. Go find another lender, okay? I'm the one who has the gold. I get to make the rules. Every time, no exceptions, a handshake is not a secure investment, okay? I watch a lot of people's court. I love me some Judge Marilyn, all right? And a lot of the times that these people are going to court is because they're lending money to a friend, a boyfriend, a family member, and they're going off of the good handshake, the good relationship that they have, and they don't have the paperwork. And Judge Marilyn says it all the time. She's like, y'all, this is the time that you want the paperwork because you don't want that relationship to go sour, to go south, right? Because now, if you don't have the collateral or the paperwork backing you, now you lost your money. Now you got to go fight for it back. And then now you have no relationship with that person, right? I mean, that's the time that you absolutely want to have the paperwork in alignment. Right now, even like I sold my last car. Okay. So like I bought my Bronco back in November of 23 and I had a Buick LaCrosse prior to that. And I have a friend who needed a new car. And I said, well, girl, do you want to buy my car? And she says, yeah, but I just can't buy it all up front outright. And I said, okay, well, I'll do some seller financing with you. Obviously I'm charging her interest for it, just like if she had to go and take a loan from any other bank. And I have that collateral of the car keys, the paperwork. This car is still mine. And if she ain't paying me, I'm going to come and get that car from her. And I had her sign the promissory notes, right? Even though she's a good girlfriend, hey, this is business at the end of the day. You see? So get the good paperwork, get the good collateral. And I would even say get into the right rooms. The conversations that are happening in private, there's going to be public news soon. So being in these right rooms means you hear things early enough to protect yourself. So really get out there. I would go to some of these trusted folks who you vibe with, get out there and go to some of their seminars. I know that Chris Noggle right now is, he's hosting a lot of his money tanks, okay, for the Private Money Club. Go out to one of his events, and see really what they're doing. Ask the questions. You could be around other like-minded people too while you're out there. Dexter, I can see you, Dexter, you've been to some of Chris Noggle's events. You've probably gotten a lot of knowledge out of them. I even know where we met at, which was a note investing event. You're always out there continuing your education, learning more and more, because again, you got to go do your own homework, go do your own research before you get into any investing journey here. All right, let me see some of these comments that are coming in. Good morning, Annette and Mr. Dave. I see y'all. Devon actually says, no question, I live that nightmare. My heart goes out to Brandon. Sarah Jean, you definitely can't bank on equity. Same thing happened to a lot of Burr investors in 2008 who lost a lot of money when the market tanked. I remembered it too well. Yeah, 100%. I'm not putting that comment up here, Dexter. I see you. Oh, he says, love the shirt message. I love the shirt in the message. And he also says, trust but verify. And Daryl says, great job. Thank you, Daryl. Good to see you. I don't think I've seen your name pop up here before. So welcome to the community. All right. Yep. I guess I could kind of end here. Here's my big shirt for today. Spread kindness. I love her. I actually got the same shirt for my mama, but I got the oversized t-shirt and I got her like the feminine, like kind of cut t-shirt, if you will. I love this shop. They're actually based out of Jacksonville. Real quick, do you get the name of the document that allows you to take the property back without foreclosure? No, not right now. I mean, really what I have is that I file the lien with the county so that I have my name on the property so that if something does happen, I do go through the foreclosure process. So Dave, I know what you're asking me, because even, was that last week that you asked me when I was going to have my conversation with Steinhaus? I don't, but how I protect myself is I record it with the county so that, hey, when you search up the property, it is owned by my LLC name. You know what I mean? So also, by the way, Dave, you are doing some cool things within the residential assisted living space. I know you're getting into that whole world. Congrats, by the way. It's a great place, especially with you and your background. You're going to truly be great with it. Yes, it's in the notes someplace. Okay. No, so even to that extent, that's something else that I'm kind of like looking at is the residential assisted living. He says scary but excited. No, it's good, because honestly that's like somewhere else that I kind of want to go into, because there's a huge opportunity with all like the baby boomers going into assisted living care. It's a big opportunity for us right now, especially us younger folks who can get in as investors and help people. Okay, at the end of the day, you kind of go through these swings too, like as an investor, where you get into investing because you're like, hey, I'm trying to beef up my portfolio. I'm trying to beef up my cash flow, my passive monies that are coming in, taking back the time freedom for myself. And you get to that place where you're like, wow, cash flow is really coming in. I'm enjoying this. And now it's more so I'm doing this because I want to help people. I still think about this one story to this day where one of my clients, she's a note investor, and she's helping a widowed mother. Husband passed away unexpectedly. No, did not have life insurance. Big PSA, do you have life insurance on your body? The only insurance that's actually guaranteed to happen. If you don't, holler at your girl. That's a big PSA. But anyways, husband didn't have life insurance. The mother, stay-at-home mom, they had no investments. All the cash flow that was coming in was from the father who was going out there and working, or I should say the husband. They had a kid, okay? But it was the husband who was going out there and working, trading his time for the money. So once he was no longer here, there was no money that was coming in. And the mom, it was a mother and 2 kids. They were about to lose their house. They're about to get foreclosed on from the bank. And that's what's kind of fun with like note investing is that when you see those stories and the powerful things that you can do to help people, you know, she got in there and she says, hey, look, let's renegotiate this. All right. You need your payments to be a little bit lower for right now. Let's lower the payments because I don't want to see you out on the streets. Let's come in here. I'm going to take over this note. I'm going to give you some time. And then we're going to come back and renegotiate this. And then again, hey, if something goes south, let's say the mother isn't paying. Well, hey, she has that collateral of the note on that property. So you kind of get to this place within your investing journey that you're like, all right, this is cool. I got cash flow coming in, but now I'm really to this point where I want to help people because it can be a win-win scenario. All right. I went off on a whole tangent not too long ago about this guy who's flying with Zach. He's like, well, that can't be right because in order for me to win, you have to lose, or for you to win, I have to lose. No. It should be a win-win scenario. And again, you get to that point within your investing journey that you're like, all right, this is really a true win-win scenario. I'm helping you. You're helping me as an investor. I got dollars that are coming in, and now you can continue to raise your 2 kids within this house now, and y'all aren't being put out on the streets or having to go find rent somewhere, uproot your entire life as you're going through this grief and adjusting to this new reality of no longer having your hubby. So you kind of get to that mindset too as you continue on this investor journey. But again, y'all, you know, I'm just kind of sharing like my experiences as I continue to go through life. I gain more experience, gain more wisdom. And I know I'm going to have some downtimes within my investing journey. Like even right now is kind of like a little downtime. You know, I'm going to have to go and do some foreclosures. I'm going to have to go and do some stuff that I really don't want to do, don't have time to do it, but gonna go do it because I at least want my principal returned back to me. You know what I mean? Just the reality. So again, instead of always looking on the offense side and always what's happening on the upswings, you should truly be looking at what can happen if things do go south, do go sour too, and protecting yourself in that manner. So thank you all for being here. I'll be back next Thursday. All right. So next Thursday, we are going to be getting into the white papers of comparing apples to apples, buy term and invest the difference versus the infinite banking concept. And I really want to mathematically debunk a lot of this for y'all. Okay. Thank you for being here. All right. Hopefully this was insightful. Hopefully you learned something. I'm looking at my Instagram comments now. Good morning, Miss Tess. I see you over there. But hopefully this was helpful. Hopefully we kind of learned some stuff. We're kind of getting real with ourselves of what it's like to be an investor, especially right now in today's economy. But I love y'all. I will be back next Thursday. We are driving back home, back to Grandma's house today. And I'll be back at it. I'll be back in my office here next week. So send me an email if you want to have some conversations with me. Hannah@themoneymultiplier.com. Let me put that in the comments for y'all just so you have it. Good. All right. Until next week, my friends, do well, be good. Don't do anything that I wouldn't do. And I'll catch you next time. Mwah. Bye, everybody.